In the fast-paced world of business, one crucial aspect stands out: business combinations. Today, we delve into the intricate realm of acquisition accounting, a vital skill for budding professionals. Picture this: two companies merging, creating a powerhouse. How do we navigate the financial landscape of such a union? Stay tuned as we uncover the key principles and practices. From initial valuation to post-merger integration, each step holds significance. Let's break down the complexities into digestible insights, paving the way for a deeper understanding of this essential topic. So, grab your seat as we embark on this enlightening journey into the world of business combinations. In the dynamic world of business, a key concept to grasp is a business combination. This occurs when one company gains control over another entity, often through acquiring majority ownership or all assets and liabilities. But why do companies engage in these strategic moves? To boost market share and customer base, embrace new technology, slash costs through economies of scale, swiftly enter new markets, squash competition, and diversify their offerings. Picture the chessboard of commerce, where every move counts towards growth and success. In the dynamic landscape of business combinations, strategic mergers have shaped industry landscapes and created powerhouse partnerships. Consider the acquisition of Pixar by Disney in 2006, a $7.4 billion deal that brought together cutting-edge animation technology and creative genius, spawning blockbuster franchises. Moving forward to 2017, Amazon's bold move to purchase Whole Foods for $13.7 billion not only signaled its foray into the grocery retail market but also marked a significant expansion of its physical store presence. Then, in 2012, Facebook's acquisition of Instagram for $1 billion proved instrumental in its expansion into mobile photo sharing, attracting a younger demographic to its platform. These real-world examples highlight the strategic foresight and bold moves that define successful business combinations. In the world of business combinations, the acquisition method reigns supreme. Whether under U.S. GAAP or IFRS, this approach, also known as purchase accounting, mandates that the acquirer values the acquired business at fair market value on the acquisition date. This means recognizing and measuring all assets and liabilities at their current fair values, not their historical book values. The assets acquired and liabilities assumed then find their place on the acquirer's consolidated balance sheet. Think of fair value as the price that market participants would willingly pay in a well-ordered transaction. It's about capturing the essence of value at a specific moment in time. Ever wondered how companies handle acquisitions? Enter the realm of acquisition accounting, a meticulous process in 5 vital steps. First, we calculate goodwill, capturing the intangible value in play. Next, assets and liabilities get their moment under the spotlight. Then, we measure the consideration, the heart of the deal. With the date determined, the scene is set for the final step, identifying the acquirer. Each step intricately woven, each detail crucial in the dance of acquisition. From goodwill to the ultimate acquirer, the journey unfolds with precision and purpose. Who takes the reins in a business acquisition? Step 1. Identify the acquirer. This pivotal player gains control over the other entity through majority ownership or strategic influence. Signs of control include holding the largest voting interest, shaping key decisions, and driving the merger. Why does this matter? The acquirer's financial landscape shifts post-merger, impacting policies and presentation. Understanding the acquirer sets the stage for a clear accounting path ahead. Takeaway: recognizing the acquirer shapes the financial future of a combined entity. As we move to step 2, let's pinpoint the acquisition date. This crucial moment marks when the acquirer gains control of the acquiree. Typically, it aligns with the closing date, signaling the shift of legal ownership. However, nuances exist. Control might be secured before or after this date. Remember, all fair value assessments hinge on this precise moment. From the acquisition date onward, the acquired business's revenues and expenses flow into the acquirer's income statement. While usually tied to consideration exchange and asset acquisition, in some cases, an earlier date could be valid if the acquirer wields policy influence pre-closing. This date is the financial pivot, shaping the future narrative of both entities. And that's the key, a single date setting the stage for financial fusion. Ever wondered how an acquirer determines the value of a deal? Step 3. Measure consideration transferred. Consideration is the price paid for control, encompassing cash, stocks, contingent payments, and other assets, all valued at fair market rates. Cash, the straightforward option. Stock issued, reflecting current market value. Contingent payments hinge on future performance. Other assets like property evaluated for worth. In the complex world of acquisitions, every element counts towards the total consideration. So, how do these factors shape the final deal? Ever wondered how companies truly gauge their worth in an acquisition? Enter Step 4, Fair Value Adjustments. This crucial stage bridges the gap between a company's recorded value and its actual market worth. Through this intricate process, the acquirer ensures their balance sheet reflects the economic reality at the time of acquisition. Historical cost accounting rarely captures present market values, making fair value adjustments essential. It's like peeling back layers to reveal the true financial picture. In a world where perception can differ from reality, these adjustments bring clarity and accuracy to the table. Ever wondered how companies adjust their fair values to reflect the true worth of their assets and liabilities? Let's dive into the common fair value adjustments they make. Inventory gets a makeover by aligning its value with net realizable worth, while property and equipment step up to reflect current market buzz. Intangible assets reveal hidden gems like customer relationships and patents, adding depth to the balance sheet. Liabilities undergo a facelift to match fair value, unearthing potential contingencies. From inventory tweaks to liability facelifts, fair value adjustments keep financial landscapes fresh and accurate. Ever wondered how a company like XYZ Corporation adjusts the values of assets and liabilities when acquiring another business like ABC Company? Well, let's dive in. Most assets see an increase in value, while liabilities hold steady. Total fair value adjustments boost net assets by $750,000, with the building's value soaring and a hidden gem, a $300,000 brand name asset, coming to light. These adjustments will impact future depreciation expenses, shaping the acquirer's profitability down the line. Remember, the choices made at acquisition can ripple through an organization for years to come. Ever wondered how to calculate goodwill in a business acquisition? Goodwill represents that added value beyond tangible assets, encompassing intangibles like reputation and potential growth. To find it, subtract the fair value of assets and liabilities from the purchase price. This residual premium signifies the goodwill amount, reflecting the strategic value of the acquisition. For a clearer picture, consider factors like workforce quality and market position. Goodwill quantifies the unquantifiable, offering insight into the true worth of a deal. Remember, in business, sometimes the most valuable assets are the ones you can't touch. Ever wondered how a $2 million premium emerges in a goodwill calculation? Let's dissect Megacorp's acquisition of TechStart Incorporated step by step. Megacorp paid $10 million in cash and stock, while TechStart's identifiable assets were valued at $12 million, and liabilities assumed at $4 million. Crunching the numbers, we find that the net identifiable assets amount to $8 million, leaving the recorded goodwill at $2 million. But why the extra payment? Megacorp sees value in TechStart's talented team, loyal customer base, and synergies with its own products. It's not just about the numbers, it's about investing in potential. What does goodwill represent? It embodies a skilled workforce and management expertise driving success. It's the foundation of customer loyalty through established relationships and repeat business. Goodwill also fosters synergies, leading to anticipated cost savings and revenue growth. Additionally, it strengthens market position by building brand reputation and competitive advantages. Goodwill isn't just a concept, it's the tangible force propelling businesses forward, fostering growth and resilience in a competitive landscape. Have you ever wondered how companies assess the value of goodwill? Unlike other assets, goodwill isn't systematically written off. Instead, it undergoes annual impairment testing to ensure its value aligns with current realities. This evaluation is triggered by various factors, from market fluctuations to shifts in strategy or poor financial outcomes. When impairment is detected, goodwill is written down, impacting both net income and total assets. This process serves as a vital check on the success of acquisitions, revealing if expected value has been attained. In the intricate dance of post-acquisition reporting, Chapter 6 unveils the vital post-acquisition reporting flow. Once the acquisition is recorded, the acquirer's next move is to consolidate financial statements, threading together a seamless tapestry of financial insights. This consolidation paints a vivid picture of the united entity, offering a crystal-clear view for investors and stakeholders alike. Efficiency is key as we forge ahead, ensuring a unified and transparent financial landscape. Ever wondered how a parent company and its subsidiary come together as one financial entity? Through the consolidation process, the financial statements of both entities are merged into a single cohesive set. The parent company's standalone financial data and the acquired company's financial data are combined, eliminating intercompany transactions to prevent double counting. The end result? A unified view of the economic entity, showcasing a complete picture of the business's financial health. Ever wondered how financial statements of parent companies and subsidiaries are consolidated seamlessly? Let's delve into the key adjustments that make this happen. First, we eliminate investments to prevent double counting. Then, we cut out intercompany transactions like sales and purchases. Next, we spread fair value adjustments over useful lifespans to avoid excess amortization. Lastly, we carry goodwill forward, testing it annually for impairment. These adjustments ensure accurate and transparent financial reporting. Remember, in consolidation, precision is key. In the complex world of business combinations, the acquisition method is a non-negotiable requirement, demanding the meticulous use of purchase accounting. This involves the precise measurement of assets and liabilities at fair value, a crucial step in the five-step process that guides these transactions. By identifying the acquirer, determining the date, measuring consideration, recognizing assets and liabilities at fair value, and calculating goodwill, companies navigate the intricate landscape of mergers and acquisitions. Through fair value adjustments, book values are aligned with current market values, often resulting in substantial increases in asset values. The calculation of goodwill, derived from the purchase price minus the fair value of net identifiable assets, underscores the importance of accurately valuing intangible assets. Furthermore, ongoing requirements include the annual testing of goodwill for impairment and the consolidation of financial statements each period, ensuring transparency and compliance in financial reporting. So, in the dynamic realm of business combinations, precision and diligence are paramount for sustainable growth and success. Welcome to our practice quiz on the mini-case scenario of Retailco's acquisition of ShopMart. Let's dive in with 3 key questions. Firstly, what is the total fair value of identifiable net assets? Calculating to $3.4 million, considering inventory, equipment, building, and the customer list. Secondly, how much goodwill should Retailco record? The answer is $1.6 million, derived from the acquisition cost minus the total fair value of identifiable net assets. Lastly, what is the total amount of fair value adjustments? It sums up to $1 million, encompassing all adjustments above book value. In summary, understanding these values is crucial in evaluating acquisition impacts accurately.